The Australian Financial Review.
Here is the very core of our well-being. A sturdy roof to live under, a patch of ground, trees, and the fresh, clean wind. There is much to be done before every family can enjoy a home of their own.
For many people in the past, the great Australian dream was a house on a quarter-acre block with a backyard for cricket and a barbecue. But somewhere along the way, our property dreams got bigger.
We're selling, and we're sold. Congratulations and well bought to you, folks.
Roughly 1 in 10 working adults owns an investment property, and 30% of them own more than one.
Imagine owning 25 properties by the time you're 25. Well, a Sydney man has done it.
For decades, bricks and mortar has been the ultimate wealth-building winner, but the landscape has shifted.
Australia is in the grip of a property price plunge.
Perfect storm of rate rises and property tax changes.
Changes to tax concessions kick in.
The Albanese government has rewritten the rulebook, changing the one thing that Australians love more than property itself, getting a massive tax break on it.
Financial advisors who before the budget said, yep, investing in residential property, it's a no-brainer, they're now saying, well, I'd wait, and actually I'd consider these other options to build wealth.
This week, wealth reporter Andrew Hobbs and property reporter Lucy Slade unpack our national obsession, explain why property has been such a powerhouse, and ask a previously unthinkable question: is investing in property even worth it anymore? Welcome to The Fin. I'm Fiona Buffini, in this week for Lisa Murray. It's Thursday, July 9. Hi Lucy, hi Andrew. Thanks for coming on the podcast.
Thanks for having us, Fiona.
Hi Fiona.
Australians are property investing obsessives. 2.5 million of us own a property and rent it out. But the government has just killed off 2 big tax breaks for investors and prices are now starting to fall. But before we dive into all of that, Lucy, just remind us, how good has property been as an investment up to now?
It's actually pretty incredible when you look at the history of Australia's property prices. So a stat that sticks out to me is that property prices have gone up 400% since the year 2000. And then when you compare Australia globally, Sydney is the second most expensive city in the world. Melbourne's about 9th and Adelaide's even in the top 10. And a lot of people point to the tax benefits as being part of that. So in the 1990s, when the Howard government introduced the 50% discount on capital gains, it kicked off so much investment just with ordinary people looking to get into residential housing. Investors flocked into the system knowing that they could negatively gear their properties and reduce their tax, and they could easily make up for the losses when they sold because half of the profit or half of the capital gain would essentially be tax-free. So I think it is pretty fair to say that property has been a very lucrative investment for those in the last 30 years.
Yeah, the price growth has just been stunning. And Andrew, how has property compared with shares over the same period?
Well, Australian shares have actually done a bit better.
Right.
Australian shares, they're up nearly 500% since 2000, and US shares have risen more than 500%.
Mm-hmm.
But when you talk to financial advisors, and it's worth saying here that we aren't financial advisors, and this isn't financial advice,
Yep.
but financial advisors say people don't really care about that when they come to see them. I spoke to Jonathan Philpott of HLB Man Judd.
This is probably one of the most common questions advisors do get asked.
And he told me that the first question that everybody who's got on top of their mortgage asks him is,
Should I buy now an investment property?
how do I go about doing it?
Tends to start with a unit, like a smaller property purchase.
And what they want to do is buy a flat near their home, usually within a 5-kilometre radius of their home.
Mm-hmm.
There are a lot of reasons to buy an investment property that don't kind of relate to investment. You can walk around it, you can see it, you can touch it. It's a real thing. Whereas every other investment, you don't get to see, you don't get to poke around. I mean, with a share, you don't even have a share certificate anymore. It's just numbers on a screen. Whereas property is something you can walk in, talk about. Everybody knows what it is. It's easy to understand. And he's always said before the budget, if they've got the cash flow, i.e. they can make the repayments, and they understand that property is going to be a 20-year investment, and if they don't mind putting all their assets really into one basket, given that they've already got a mortgage on their house, and if that's the case, then he basically says, go ahead. When Jonathan then asks those would-be investors why they want to buy a property,
And the number one reason for that is always the negative gearing.
they want to get tax back.
For most people, that's the biggest deceit, that they can reduce their personal taxable income to negatively gear into a property.
What negatively gearing, what it allows you to do is if you make a loss on an investment property, you can claim that against your salary. So every year you get money in your pocket back from the government, and that feels like free money to a lot of people.
This is the first time in my kind of 30 years in the industry where the government changes to basically negative gearing now basically kind of kill that strategy off. I'd be really questioning going down that route with them.
So the two big tax breaks, negative gearing and the discount on capital gains, are really going to be restricted from the middle of next year. Andrew, how does that change the equation for property as an investment?
Yeah, so basically from July 1 next year, you're only going to be able to negatively gear new build residential properties or commercial properties. But also those new rules don't apply to any property that was bought before May 12 budget night. So anybody that bought before, happy days. That's known as grandfathering, basically, in the financial press. And that's been a real boon for another investor we spoke to for this, Sarah Pike, who's an accountant, so she should know about this. And she's bought 5 investment properties basically across Australia's east coast over the past 16 years.
I knew that it was going to outperform pretty much every other asset class. Therefore, for me to generate wealth, property was really the only way to go.
And I mean, she admits she took full advantage of the tax concessions that came as a result of that, negatively gearing in particular. And she recognises that they helped her build wealth. But she says
I didn't go into property because I knew I was going to get a discount on it.
She views the negative gearing initially as just a bonus rather than a reason to invest. The fundamental reason for her was, as Lucy said, property's outperformance as an asset class. In her words,
I know it is a huge pull for most investors, particularly new-time investors getting into the market. So people that are buying their first investment property, it's certainly a huge consideration.
But month to month, day to day, it's not going to make a difference.
It's not going to affect my day-to-day cash flow. It's not going to affect my monthly cash flow. It's a one-a-year thing.
And that's also important. Pike points out that the other big thing in favour of investing in property is that when you invest, so many of the costs of ownership are tax deductible. So with the units she owns, the rates, the strata fees, the insurance, they're all tax deductible. She also claims depreciation on some of those items because she keeps good records. You've got to be careful about how you do that. But one of the other changes that came in with the budget were changes to capital gains tax. Until May 12, you only had to pay tax on half the gain of a property. So if your property went up $200,000, you only paid tax on $100,000 of that. Now, you pay that at your marginal rate. It doesn't mean you're paying half your tax rate or anything like that. It just means you add $100,000 to your income, and whatever tax bracket you're in, you just pay the tax on that.
And the budget changes it to?
It's indexed to inflation.
So instead of reducing your gain by 50%, you're reducing it by the inflation rate.
Yeah, which is whatever it is each year. That'll change each year. The idea of that is to take the inflation out of the gain. So you're not taxed on inflation. Negative gearing works provided your property goes up in value at the end. Otherwise, you're just making a loss all the way through. But when you make a nice big capital gain, when you sell your property, that's where the value is in investing in property. Importantly, we are talking about property investment because investing in your own home is still a really good idea because remember, capital gains tax doesn't apply to that ever. Also, when you retire, if you're going to be eligible for a pension, it counts on a lower basis than if you're renting. If you renovate it, so you add a bedroom, you add a bathroom, that'll move it up a price bracket. You can rent it out for up to 5 years. There's a whole lot of concessions that apply that make the family home a really important investment, and that was reinforced by the budget night changes.
So, Lucy, the budget changes already seem to be having a big impact on the market, even though they haven't actually started yet. You're out there talking to real estate agents and buyers all the time. What are they telling you about what's happening in the market?
The market's just really complex at the moment. There's really something different happening in each segment of the market. If we start with the major capitals, which are more sensitive to changes, sort of overall in Sydney, prices fell by 1.2% in June, and in Melbourne they fell by 1%, which is quite a big fall month on month, and it's the first full month we've had since the budget. However, if you break these numbers down a little bit more, the top end of Sydney's market, which are really talking about homes sort of above that 1.8 million but below that really prestige level, the values of those homes fell by 1.7%. The reason why this is significant is if you compare this to homes at the bottom end, which is sort of homes priced below $930,000, they fell by 0.3%. So essentially what the data is showing us is that demand from first home buyers, those people that are typically buying at the bottom end of the market, that demand hasn't fallen off as much as the demand at the top end, which is typically people with a lot bigger mortgages and who are a lot more spooked by market conditions when they change. Then moving to sort of Brisbane, Adelaide, Perth, which is what we typically call the mid-sized capitals. Before the budget, they were growing very fast. So each month they were growing between 1% and 2%. Since the budget, that growth has slowed considerably. So in June, Perth grew by 0.7%, Brisbane grew by 0.3%, and Adelaide was completely flat. So that's quite a big change compared to what we were seeing in the 6 months before the budget. Canberra, different again. It was growing slowly each month, but Canberra's values fell by 0.6% in the last month. Then if we look at regional areas, Hobart and Darwin, they don't really seem to have changed much since the budget at all, and what they're recording in June is pretty much the same as what it's been for the last 6 months, which is growth.
Also, what's happening at auctions and auction clearances?
So that's also been really interesting since the budget. Everyone's been talking about auction rates lately, and that's because they've slumped to lows seen about the same time as the pandemic. So auction clearance rates have been coming in sort of the low 40s. That means essentially only about 40% of the homes that went to auction in that week sold, which is very low. When the property market's doing well, usually that rate's around 65% or higher. Auction clearance rates are a really good sense of sort of the sentiment in the housing market. And at the moment, they're so low that a lot of real estate agents are actually switching to private treaty sales because they're worried there's not even going to be enough bidders at the auction.
So it looks like investors are deserting the property market big time at the moment. Andrew, what other investments are advisors saying look more attractive now?
Well, the big one is super. I know I've said this before, but super is a diversified investment by its very nature. Basically, in any fund you're in, it's going to have a lot of shares, it's going to have Australian shares, it's going to have international shares, and it's going to have US shares. And US shares have risen more than 300% in value in the last 15 years. That's what diversification gives you. It gives you exposure to a whole series of asset classes. You can contribute up to $32,500 a year to super. That includes your employer contributions, so-called super guarantee contributions. If you're earning about $150,000, your employer's probably putting about $15,000, $16,000 a year. So that means you've got about $16,000 a year.
If you've got the spare cash.
If you've got the spare cash, you could put into super. If you put that into super, you get a tax deduction for that full amount. That's going to be in your hand, a cheque of about $6,000 to $7,000, which is about what everybody claims on negatively gearing their property otherwise. So your tax deduction from a voluntary contribution to super can work out to be about the same as the tax deduction you'd get from negatively gearing a property. And remember that super money is your money as well. That doesn't go away. Another thing to look at if you really do want to invest in property are real estate investment trusts. Now, these are good post-budget because they tend to have lower capital growth, which means lower capital gains. They offer yields of about 5 to 6%, which is way above any yield you're getting on residential property anywhere in Australia. And you can buy those on the share market.
Also, Andrew, I've noticed in my reporting that a lot of mums and dad type investors, people that own their own home, maybe have one other investment property, are actually looking at commercial property as an investment as opposed to buying another residential property, purely because the tax incentives haven't changed in the same way they have as residential. If you do have that capital behind you, a long-term tenant like a vet or a childcare can be seen as a safer investment than a tenant that can move in 6 months, and you have a bit more unpredictability sometimes with tenants.
Another option is lower value residential property, such as studios or one-bedroom apartments. These also typically have higher yields and lower capital growth than houses. And the changes to capital gains tax do make yield a more attractive way to earn money than capital growth. If investors start chasing the yields, the high yields on offer in studios and one-bedroom apartments, which are also typically bought by first home buyers, especially in the suburbs of Melbourne, Sydney, even Perth, that dynamic will put more investors into direct competition with those first home buyers. A non-bank lender I spoke to as part of this story says that investors are already looking to increase borrowing for studios and one-bedroom apartments. It puts a new focus on yield.
Yeah, that's a theme that property platform Domain has picked up in some of their forecasts for this coming financial year. They predict that units are going to outperform houses, which is quite different from previous years. Houses have typically grown a lot quicker than units. So the budget changes might have a consequence on a cohort that no one's really talking about, and that is renters.
We've been talking about how the federal government has changed the tax rules for property investment. And Lucy, if there's fewer investors in the market, what does this all mean for renters?
I'm quite interested to see what does end up happening in the rental market from these budget changes, because the experts I've spoken to are actually quite divided. A Cotality report out this week shows rental prices are accelerating. So the median cost to rent a home in Australia is $705 per week, and that's growing by about 6% annually. It's hard to say whether the budget changes have impacted this latest acceleration in price, but the experts I speak to when we talk about the medium to long term, some are expecting quite major impacts on rents, especially in Sydney. And this matches how renters are feeling at the moment.
I am a renter, but I did have to move out of Sydney to afford my rent. I've had to move regional.
Some of the renters we spoke to are bracing themselves for rents to go up like they did back in COVID times.
You know what? My rent's going to go up anyway. It was always going to go up. If there's any opportunity every year to raise the rent, it's going to happen regardless of this. Yeah, that's just a normal thing that happens once a year now, right? Yeah.
It's either investors are just putting their prices up, or it's investors are selling to first home buyers and there's just less rental stock, so prices are going up because there's less supply.
Okay, so the experts are a bit divided on rents, but they're pretty unanimous that house prices are trending down or that growth is slowing at the moment. What's the best prediction for where property prices are going in the next few years, Lucy?
So most economists expect the downturn to last for about 6 months in Sydney and Melbourne. Prices will likely be the lowest they'll be around November, and then in the first 6 months of next year, prices will likely be flat. But the next interest rate decisions will be really key in determining what prices will do in the next 12 months. So stepping back, some of the biggest predictions of price falls I've seen is about 20% in Sydney. Even if prices did fall by that much, it's only really going to take us back 4 or 5 years because we've had such considerable price growth in that time. So the reason why we're in a downturn in Sydney and Melbourne at the moment and not in a housing crash is because we've still got a major problem with undersupply. So essentially there's still just not enough homes for people in Australia, and that's really stopping prices from completely bottoming out.
Yeah, with property, timing really matters. I'll give the example of my brother. He bought a 2-bedroom terrace in Crow's Nest. That's a suburb in Sydney. It's an inner suburb, and it was just before the huge property boom in the 1980s. He paid about $60,000 for that, and then in a couple of years, he sold it for $200,000. So there he's thinking he's just the smartest man in the room here. So he used that to upgrade to a 3-bedroom house in North Sydney. He paid $250,000 for that, but 5 years later, he got a bit less than $250,000 when he sold it and moved again. Now, I just had a look at what that property's worth now. It's worth over $5 million. But it's been renovated and extended, and it is 35 years since my brother owned it. But it just shows you that property prices, they jump up, stay flat, jump up, stay flat, dribble down, jump up, and so on. That's why financial advisors say you want to have a 20-year time frame when you're buying an investment property, because you've got to smooth that out. So that's why if you get it wrong and you buy over a shorter time frame, property could be the worst investment you'll ever make. But if you get it right, it's sensational.
The government was very clear about the budget. These changes were designed to help first home buyers. So Lucy, are they doing what they're meant to? Are they going to help young people?
Well, in short, yes, they are good for first home buyers. They've really reduced competition, so buyers have a lot more chance of being successful at auctions because they're not competing with investors that often have much deeper pockets than they do to bid on properties. For first home buyers at the moment, they're not really benefiting from these massive price falls that we're seeing at the top end, but the market's essentially just stalled at the moment, which is really handy for being able to catch your breath, being able to take a bit more time to really choose a property that you want and not having to just take what's on offer because you're afraid of missing out and prices going up further than your borrowing capacity. There is a small risk of negative equity for first home buyers, which would be, let's say you bought a property today, in 3 months' time it might be worth slightly less than what it is today. That's only really an issue if you've bought on a 5% deposit and for some reason you need to sell that property, you're then in a pickle. But overall, if you're planning to be in that house for multiple years, you should be fine. The other winners at the moment are people looking to upsize their home because homes at the top end of the market are falling in value. I feel like I'm breaking a bit of a golden rule of journalism here and talking about myself, but I feel like my situation is actually quite relevant to explain what's happening in the market. So my husband and I, we both own an apartment and we were looking at some point in the future getting a bigger home. So we have been keeping an eye on the real estate market, and for context, we're sort of looking at homes on the edge of the inner city, which is, for people that know Sydney, sort of Marrickville, Sydenham, Earlwood, Canterbury, which is about 30 to 45 minutes out of the CBD for those that don't know Sydney. We've noticed just in the last 3-4 months that the homes we've been looking at have fallen by up to $300,000.
Wow.
So suddenly we can either buy a lot closer to the city or we can sort of stick with the same properties we were looking at and just pay about $300,000 less. So people sort of in that sweet spot that are upsizing, that are financially stable, because the biggest risk with upsizing at the moment is your home not selling. So if you're confident that your home can sell or you have sold your home, it's probably not a bad time to get a bigger family home because you're paying less than you would have a couple of months ago, and in a year or two's time, prices will probably go back up to that point. So it's not just first home buyers who are winning in this market, it's also just a small cohort of upsizers too.
Okay, and so a final question to both of you, and coming back to where we started this, what's the verdict? Is it worth investing in property in Australia anymore?
What people have told me is don't buy now. If prices are falling, then why jump in? While you're waiting, if you've got a deposit saved up, you can get a decent return on your cash. At the moment, interest rates are rising. It's one of the reasons property prices are falling. And the other thing to look at is topping up your super. Super is more diversified, and if you're in your 40s, it's got the same long-term time frame as a lot of property investment. You've got to lock it away for about 20 years before you're going to get the benefit from it. Putting your money in super is way more tax effective than putting it into direct property, especially after budget night. And if you still want to get into property, then experts are saying look at commercial property, look at real estate investment trusts.
Owning your first home is still the most important thing. Once you've sort of got that sorted, is investment a good idea? I think in the short term, maybe, but in the long term, the experts I'm speaking to say these price falls are just a downturn and they expect property prices to keep rising, especially, like I said before, we've still got that undersupply problem. We've still got not enough homes for people, and until that changes, investing in property, if you can afford it and if you've got enough capital, is still going to be a winner.
Good luck with your house hunting, Lucy.
Thank you very much.
Thanks, Andrew.
Thank you.
Thank you for listening to The Fin. If you want to read more about the budget and what's happening in the housing market, check out the show notes. The Fin is produced by Mandy Coulin and our theme is by Alex Gow. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. I'm Fiona Buffini. Lisa's back next week.
The Australian Financial Review.